The Indian stock market has been on a roller coaster ride, but you've been tracking mid and small caps. You know that this isn't just another correction. This is mayhem. Portfolios are bleeding. Stocks that were flying high just a few weeks ago are down 20, 30, even 40%. And the biggest question on everybody's mind is what's happening, and more importantly, is the worst over or are we just getting started? In this video, we'll break down exactly why mid and small caps are crashing, what triggered this chaos, and what happens next. Stick around till the end because I'll also share my take on whether this is a time to panic or a rare opportunity for smart investors. Let's start with the numbers. The BSE Small Cap Index is down nearly 23% from its recent high. The Mid Cap Index has also tagged by almost the same percentage. In contrast, the Nifty and Sensex are barely down 12%. This is a sharp divergence and it tells us something. This crash is isolated to mid and small caps. So what is causing it? The first major factor is SEBI. Over the past few weeks, the market regulator has been raising concerns about the sheer amount of money flowing into small and mid-cap funds. Too much liquidity was chasing too few stocks, creating stretched valuations. SEBI has signaled that it wants better risk management from fund houses, and the moment institutions realized that regulations could tighten, they started cutting exposure. The result? A selling spree. That takes us to the second reason, institutional selling. FIIs or foreign institutional investors have been offloading Indian stocks aggressively. In the second half of 2024 alone, they pulled out more than $15 billion from the Indian markets, and a significant chunk of that came from mid and small caps. When big money exits, the liquidity in these segments dries up very fast, leading to deeper corrections. Meanwhile, retail investors who had piled into these stocks at very high valuations are panicking. Mutual funds focused on mid and small caps are seeing redemption pressures, forcing them to sell more stocks to meet withdrawals. And as more selling happens, the correction deepens. Before we discuss what happens next, a quick reminder. If you're finding this analysis useful, make sure to subscribe to the channel or join our Telegram group. The market is moving fast and I share real-time insights to help you make informed decisions. Now, back to the discussion. Let's talk about valuations. Even after this sharp fall, mid and small caps are still trading at historically high price to earnings ratio. Before the crash, many stocks were running at absurd valuations. Businesses with mediocre earnings were trading at 70, 80 or even 100 times their profits. So, was a correction inevitable? Absolutely. The only question was when. The bigger factor at play here is global. With the US Federal Reserve still uncertain about interest rate cuts, a strong dollar is making FIIs cautious about emerging markets. Add to this India's own macroeconomic concerns, rising bond yields, inflation fears, and a slight slowdown in corporate earnings, and you have the perfect storm. So, where do we go from here? Is this the time to buy or is there more pain ahead? There are three possible scenarios. The first is a relief rally where selling slows down, institutions find value in quality mid and small caps, and the market bounces back by 5 or 10%. The second is a sideways consolidation where markets remain volatile but large-scale panic selling will stop. This phase could last for a few months, allowing valuations to normalize. The third is a deeper correction where institutional selling continues, retail panic worsens, and the market drops another 10% before stabilizing. Which scenario plays out depends on what happens with SEBI's next steps, FIIs flows, and global market trends. Now, what should investors do in this environment? If you're holding mid and small caps, review your exposure and ensure that you're not over allocated. Stick to companies with strong earnings growth, low debt, and real business strength. Avoid panic selling in fundamentally good stocks. If you're looking to buy the dip, don't rush in. Identify stocks with solid financials and add gradually instead of deploying all your funds at once. And if you prefer safety, large cap stocks and defensive stocks like FMCG and pharma may be better options right now. My take, the worst of the panic might be behind us, but volatility is not going away. Mid and small caps will take time to stabilize. The key is to stay patient, focus on quality, and avoid emotional investing. This mayhem is far from over, but smart investors know that every crisis creates opportunity. Stay sharp, stay informed, and if you want real-time updates, join the Telegram group. Let's navigate this together.